Hello, John Gillespie here with Occam's Investing. Today we're going to do something different. Instead of running a standard discounted cash flow, we're going to show you why certain companies need a completely different valuation approach. We're looking at Enterprise Partners, ticker EPD. This is one of the largest midstream energy companies in the world. They move natural gas, crude oil, and petrochemicals through pipelines, and they've been paying increasing distributions to their unit holders for over 25 consecutive years. That makes them a dividend king. Now, if you've tried to run a standard DCF on EPD, you've got numbers that make no sense. The last time we ran EPD through a traditional DCF, it came back with an intrinsic value of $334 billion. For a company trading at $39, that's absolutely wrong. And for the reasons it's wrong, tells you something important about different types of companies. They need different types of models. So why does DCF break for pipeline companies? 3 reasons. First, pipelines distribute most of their cash flow, and DCF model assumes the company retains it and reinvests earnings to grow. But EPD's whole purpose is to pay that cash out to unit holders. Trying to protect future cash flows for a company that distributes them is like measuring a fish for how well they climb trees. Second, pipeline companies carry substantial debt. By design, they finance long-lived infrastructure assets with long-term debt. A traditional DCF sees that debt and penalizes the equity value, sometimes to zero or negative. But that debt is backed by 20-year contracts and physical assets that generate predictable fee income. Third, the growth rate assumptions in a DCF don't apply. Pipeline companies don't grow like tech companies. They grow by building new pipelines, acquiring assets, and raising their distribution. The growth is in the income stream, not the top-line revenue. So Occam's Investing built a dedicated pipeline model. When you enter EPD or any midstream company, our system automatically detects the sector from the company's industry classification and routes it to the pipeline model instead of the standard DCF. Here's what the pipeline model evaluates: distribution cover. This is the most important metric. EPD's operating cash flow per unit is $3.89. The distribution is $2.17. That's a 1.79 times coverage ratio, meaning for every dollar they pay out, they generate almost $1.80 in cash. That's a very healthy cushion. Distribution yield for EPD is currently yielding about 5.5%. For a midstream MLP, the sector median is 5.5 to 6.5, so EPD is right in line with its peers. Distribution growth. EPD has grown the distribution for 3 consecutive years, and their track record goes back over 2 decades. That's not a company that is going to surprise you with a dividend cut. Earned value over EBITDA. This is the valuation multiple that matters for pipelines, not P to E. EPD trades at about 11.9 times EV over EBITDA, which is at the upper end of the typical 10 to 12 times range for quality midstream assets. Fair but not cheap. Debt to EBITDA. This is the leverage metric for pipelines, not debt to equity. EPD's debt to EBITDA came in around 7 times, which is above the 5 times threshold would like to see. That's the one flag in the otherwise strong profile. Interest coverage is 5.06 times. They can service their debt comfortably, not a concern. Our pipelines model uses a yield-based intrinsic value. The formula is simple: annual distribution divided by the sector median yield. EPD pays 2.175 per year. Divide that by 6% yield and you get an intrinsic value of $36.25. The current price is $39. That's a negative margin of safety of about 7.6%. In other words, EPD is slightly overvalued relative to their income stream. Not dramatically, it's close. It's to fair value, but you're not getting a discount. Now let me step back and explain what's happening under the hood, because this is what makes our platform different. We've built 6 sector-specific valuation models. When you enter any ticker, the system detects the company's sector and industry from a financial profile and automatically routes it to the right model. Standard DCF for most companies, tech, healthcare, consumer staples, use DeModern's methodology with 10-year cash flow projections. REITs, real estate investment trust, we value on FFO and AFFO, dividend coverage, and LTV ratio. Because REITs are required to distribute 90% of their taxable income, a DCF doesn't work. BDCs, like REITs, business development companies, they're evaluated on net asset value and net investment income, coverage, and portfolio quality. These are lending vehicles where traditional metrics like operating cash flow are structurally negative. Banks are evaluated on tangible book value, not interest efficiency and interest efficiency. Banks make money on lending spread, not operating cash flow. Pipelines, what we just talked about with EPD. Yield-based valuation, distribution coverage, debt over EBITDA, cyclicals, companies like GM and Ford, where earnings swing wildly with the business cycle. We use normalized earnings over 5 to 6 years instead of a current earnings, and we detect where you are at peak versus trough. The key insight is that one model doesn't fit all companies. A DCF on a REIT is wrong. A DCF on a bite line is wrong. A DCF on a bank is wrong. And you're using a platform that gives you the same model for every company. You are getting the wrong answer most of the time. Let me give you a quick contrast. We recently ran General Motors through our cyclical model. GM is at cyclical trough. Gross margins compressed from 14% to 6%. Earnings are down 42% from their cycle average. The cyclical model gave GM a normalized intrinsic value of $80 versus a price of $76, a small margin of safety, but at trough, which is traditionally the best time to buy a cyclical. Compare that to EPD. EPD doesn't have a cycle the way GM does. EPD has fee-based contracts, predictable cash flows, and a 25-year distribution track record. The question for EPD isn't where we are in the cycle. It is the income stream and is it fairly priced? Two completely different questions, two completely different models. Same platform. Now scrolling down to the AI model analysis. The forensic jury weighs in. 3 AI models. And then reconcile their views. The narrative points out EPD's strong distribution, the 25-year track record, and the diversified midstream operations. So we scroll down. Basically, the yield-based value, market price is 39. So as we mentioned, it's just a little bit above that. And the AI, tell you the DCF model is limited. It doesn't really apply to EPD. But it also flags the elevated debt to EBITDA ratios as a concern for distribution sustainability during potential downturns. The final verdict hold with medium confidence. The income stream is safe, the company is well run, but the price doesn't give you enough margin of safety to say definitively to buy it. If it pulled back to the low 30s, closer to intrinsic value, that changes the picture. So that's the takeaway. If you own EPD for income, like I do, the distribution is well covered and likely to be sustainable. If you're thinking about buying it today, you're paying fair value for a quality income stream, not a deal, not a ripoff. And the broader lesson is make sure whatever tool that you're using to evaluate stocks is using the right model for the right company. And one size fits all DCF will mislead you on income vehicles like pipelines, REITs, and BDCs. It'll mislead you on cyclicals as well. We built 6 models because we kept finding sectors where the standard approach gave dangerously wrong answers. If you want to try it yourself, log on to Occam's for free. You can run several. No accounts even required for the first run or two of evaluation. Link is in the description, and if you want to see how we analyze CrowdStrike and AMD with a standard DCF model, those videos are on the channel. Coming up next, we'll look at a REIT and show you why FFO matters more than earnings for real estate. Thanks for watching.